Hello, and thank you for joining us on our webinar on transferring life insurance policies. So what happens when the owner of a life insurance policy transfers ownership to another person or entity? There may be sound reasons for doing this. The original need may have gone away and there is no longer any need for the owner to insure a potential loss. The need may have shifted to someone else. A company may be sold and the life insured wants to now own the policy interest personally or through a holding company. A shareholder may own a life insurance insurance policy personally and wants to transfer ownership to their company to cover a corporate need for life insurance. The original owner passes away and while the policy is in force, or an individual wants to use permanent cash value life insurance as part of an intergenerational transfer of wealth and assets. Whatever the reason, a disposition may be deemed to occur. The policyholder may need to include income from the disposition of the interest in a life insurance policy in their taxable income for the year in which the disposition or transfer occurs. So what constitutes a disposition? What are the tax considerations? What about the impact, the adjusted cost basis of the policy for the new owner? Are there tactics that can reduce the income inclusion for the transferor? And does tax always get triggered? Transferring the life insurance interest in a life insurance policy happens more often than you think. You will learn about what happens with various scenarios involving the transfer of an interest in a life insurance policy. This session includes sample calculations, considerations, and consequences for the transferor and transferee. Advisors will be better equipped to guide their clients through the deliberations and decisions involved in transferring an interest in a life insurance policy. Please review this on our own. This is your disclaimer slide from our compliance people. So what we're going to look at today, to give you a brief overview of what's coming, we'll start by looking at what a policy disposition is, what situations are included in the term disposition, and the consequences of disposing of a policy. We'll look at different means of accessing the cash value of a life insurance policy. We'll look at different consequences of each of these means and how they can influence the recommendations advisors make to their clients. We'll also look at different forms a policy transfer can take. Again, here we'll target key aspects of these transfers that should be considered by advisors and clients who consider the transfer of a life insurance policy. All these concepts and situations will be examined in the context of examples based on situations that we often see in our practice. The definition of disposition is provided in the Income Tax Act at section 148 sub 9. This definition provides that a disposition in relation to an interest in a life insurance policy includes a surrender of the interest in the life insurance policy, which in itself includes a partial surrender of the interest. Such partial surrender of an interest will occur when a policyholder withdraws part of the cash surrender value of their life insurance policy. A disposition also includes a disposition of the interest by operation of law. The nature of such operations of law, as well as the parties that they may involve, can lead to many different fact situations. We'll look at some common situations later in the presentation. A disposition in a life insurance policy also includes situations where a policy loan is made. However, if the interest in the policy is assigned for the purposes of securing a debt or loan other than a policy loan, the interest in the policy will not be deemed to be disposed of. Subsection 148 sub 10 of the Income Tax Act also provides information on the disposition of a policy. The policyholder who exercises any provision of the policy is deemed not to have disposed of a life insurance policy, nor to have acquired an interest in a life insurance policy. And of course, with most tax acts, there are exceptions, and that's other than a conversion into an annuity contract. Let's review a situation that comes up from time to time. Consider a policy holder and life insured of a life insurance policy in the terminal phase of their life with less than 6 months to live. They want to change the beneficiary of the policy to the benefit of a third party, and they receive, in consideration for that change of beneficiary, that the new beneficiary will pay the premiums of the policy until death of the life insured, and the current owner receives an amount in cash from the new beneficiary. So the question here is, has there been a disposition of the life insurance policy? To determine if there is a disposition of an interest in a life insurance policy, we must look at the definition of disposition provided in the Income Tax Act at subsection 148 sub 9. According to this definition, the situation that we just saw could result in a disposition if it can be demonstrated there is a disposition of that interest by operation of law only. In order to determine if there is a disposition by operation of law only, we must determine if the change to the existing contract results in the creation of a new contract in virtue of the applicable legislation. Such determination can be done solely after examining all the facts that apply to a particular situation and after analyzing the terms of the contract and the suggested modifications. The CRA generally considers that a change of beneficiary in itself is not a modification that leads to a disposition of a life insurance policy. However, despite the CRA's general position regarding the change of beneficiary, the fact that the owner receives an amount in cash as consideration for making the change of beneficiary, and that the premiums are paid directly by the new beneficiary, could indicate that in reality, the new beneficiary has acquired an interest in the policy in question. Therefore, subsection 148 sub 1 of the Tax Act could apply to include the amount that the policyholder is entitled to receive as proceeds of a disposition. There is also information in paragraph 56 sub 1J of the Income Tax Act, which requires policyholder include income from the disposition of an interest in an exempt life insurance policy in their taxable income for the year in which the disposition occurs. The income inclusion or policy gain is the amount, if any, by which the proceeds of disposition of the policyholder's interest in the policy exceeds the adjusted cost basis to the policy. Finally, the words used in subsection 148 sub 1 of the Income Tax Act ensure that while the policy gains are taxable, a taxpayer cannot have or deduct a policy loss from their taxable income. The terms proceeds of disposition and an adjusted cost basis are both defined in, again, subsection 148 sub 9. The term proceeds of disposition is defined to be the amount of the proceeds that the policyholder is entitled to receive on the disposition of the interest of the policy. In the case of a surrender, the amount of the proceeds will equal the cash surrender value of the interest in the policy, adjusted for any outstanding policy loans and unpaid premiums under the policy. In the case of a policy loan, the amount of proceeds generally equals the amount of the loan less any portion of the loan applied to pay a premium under the policy. The adjusted cost basis represents the cost amount of the policyholder's interest in the life insurance policy. It is computed by reference to a fairly complex formula set out in the definition of adjusted cost basis, again, subsection 148 sub 9. The formula establishes certain factors that increase the adjusted cost basis while other factors decrease that ACB. Some of the factors that increase the ACB include the cost of an interest in the policy acquired by the policyholder, the amount paid for an interest in that policy, and the premiums paid on or behalf of, by or on behalf of the policyholder. Whereas some of the factors that decrease the ACB include the cumulative total of all amounts, each of which is net cost of pure insurance, which is again defined in the Tax Act and the regulations, Regulation 308. and the proceeds of disposition of an interest in the policy, including policy loans. Once the amount of policy gain has been calculated, the question is, how is this policy gain taxed? Are policy gains like capital gains or income for tax purposes? Policy gains are considered income from property and therefore fully included in taxable income. They are specifically excluded from the definition of capital gains under subparagraph 39 sub 1A3 of the Tax Act. The Canada Revenue Agency's view is that income from a corporately owned life insurance policy included pursuant to subsection 56 sub 1J is income from a source that is property or for purposes of paragraph B of the definition of aggregate investment income. This characterization of taxable policy gains as being income from property has certain consequences, including that policy gains are subject to the attribution rules, subsection 74.1, and they are viewed as investment income earned by the corporation with respect to calculating the corporation's refundable dividend tax on hand. The policyholder may choose to transfer the ownership of an interest in an insurance policy to another person. A transfer of ownership of an interest in a life insurance policy is a disposition for tax purposes pursuant to the definition of disposition. As we saw earlier, the policy gain under section 148 sub 1 is equal to the excess of the proceeds of disposition, which generally is the transfer price over the adjusted cost basis of that interest immediately before the time of transfer. The policy gain is included in the transferor's income and taxed accordingly as income. While the policy gains are taxable, the taxpayer cannot realize a loss upon the disposition of the policy. We also saw that the general rule is that the proceeds of disposition of an interest in a life insurance policy is the amount that the policyholder is entitled to receive on the disposition of an interest in the policy. The question that remains are there any exceptions? And actually, since we're looking at tax issue, the question should probably be, what are the exceptions? So let's look into that. Notwithstanding the general rule and subsection 148 sub 1, specific rules are provided in subsection 148 sub 7 of the Income Tax Act relating to certain transactions unless paragraph 148 sub 2B are applied to the disposition. The provision applies where an interest in a life insurance policy is disposed by the owner, whether for consideration or not, in one of four circumstances. It is transferred by way of gift or bequest. It is distributed from a corporation. It is disposed of by way of operation of law only, such as a transfer to a successor owner or joint tenant, or it is disposed of to any non-arm's length person. Without getting in depth in the non-arm's length rules, a corporation and a person who controls the corporation, if it is controlled by one person, are deemed not to be dealing with each other at arm's length. And so are two corporations if they are controlled by the same person or group of persons. For transfers of an interest in a interest of a policyholder in a life insurance policy after March 21st, 2016, subsection 148 sub 7 deems the proceeds of the disposition to the transferor to be equal to the greatest of three amounts: the value of the interest, the fair market value of the consideration given for the interest, and the adjusted cost basis to the policyholder of the interest immediately before the disposition. Also, when the specific rules of subsection 148 sub 7 apply, the person that acquires the interest because of the disposition is deemed to acquire at a cost equal to the deemed proceeds of disposition previously determined. Therefore, the adjusted cost basis for the acquirer will be equal to the deemed proceeds of disposition of the transferor. The first of those three elements that may determine the deemed proceeds of the disposition in the non-arm's length transfer rules, 148 sub 7, is the value of that interest. The term value is defined at subsection 148 sub 9 of the Income Tax Act. And the value at a particular time of an interest in a life insurance policy means where the interest includes an interest in cash surrender value of the policy, the amount in respect of that the policy holder of the interest would be entitled to receive if the policy were surrendered at that time. In any other case, the value of an interest in a life insurance policy is nil. So I have a couple of questions for you. If the surrender charges are in effect at the time of policy transfer, do they affect the value of the interest in the life insurance policy? Would it be affected if a policy loan had been issued prior to the transfer? In a 2008 technical interpretation, the CRA was presented with a situation where a life insurance policy had surrender charges applicable at the time of transfer. Some universal life insurance policies have an explicit surrender charge in the early years that results in very low cash surrender values during those years. The policyholder was considering a transfer of the policy in a non-arm's length transaction. So the rules at subsection 148 sub 7 would apply to the transfer. And the CRA was asked that at the time of the transfer, considering the surrender charges are still in effect, would these reduce the cash surrender value for the purposes of determining the proceeds of disposition of the policy? The CRA's response was that the question of whether or not an amount constitutes the value as defined in subsection 148 sub 9 depends upon all the terms and conditions of a policy and the law applicable to the policy. Therefore, it's not clear whether surrender charges should be deducted from the value of the interest at a particular time, and an analysis should be conducted on a case-by-case basis. The application of the non-arm's length transfer rules, subsection 148 sub 7, does not eliminate the potential taxable benefit conferred on a shareholder or an employee as the result of the transfer from a corporation. The CRA has consistently stated that a shareholder benefit, which is under subsection 15 sub 1, or an employee benefit, which is under subsection 6(1)(a) of the Tax Act, will be taxed in the hands of the transferee to the extent that the fair market value of the policy exceeds the amount of consideration paid by the shareholder or employee. If a benefit is conferred by a corporation on an individual that is both a shareholder and an employee of the corporation, a determination must be made as to whether the benefit was conferred on the individual in their capacity as an employee or in their capacity as a shareholder. This, again, is a question of fact that can only be determined on a case-by-case basis. The CRA has provided some guidance in their folios. The CRA has adopted the position that unless the particular facts establish otherwise, there is a general presumption that an employee shareholder receives a benefit or allowance in their capacity as a shareholder when the individual can significantly influence business policy. This presumption may not apply if the benefit or allowance is available to all employees of the corporation, or all of the employees are shareholders or individuals related to the shareholder, and the benefit is of comparable size or benefits generally offered to non-shareholder employees of similarly sized businesses who perform similar services and have similar responsibilities. Normally, it will be beneficial for a benefit to be considered an employment benefit rather than a shareholder benefit, because a deduction may be claimed by the employer, corporation, for an employee benefit. However, taxes would have to be withheld by the employer for the employer corporation in respect of an employee benefits. That's under subsection 153 sub 1. Failure to withhold or deduct an amount as required by subsection 153 sub 1 may result in penalties and interest. Shareholder benefits lead to double taxation since the benefit is taxable for the shareholder but is not deductible for the employer or corporation. Wanted to go on to an example of a transfer to a shareholder or employee. This table shows the results for an operating company, we'll call it OPCO here, and for the person who acquires the interest in the life insurance policy, whether that person is a shareholder or an employee of OPCO. In this example, the policy which is transferred has cash surrender value of $150,000, an adjusted cost basis at the time of transfer of $50,000, and a fair market value of $250,000. We're going to keep using these same values in a number of examples through this presentation. In this review, in this situation, we're going to look at no consideration being given by the shareholder or employee to obtain the life insurance policy. We can see from the table the taxable benefit that results from the transfer is the same, $250,000 for a shareholder or an employee. The only difference is the section that will lead to income inclusion. As we saw, the amount of $250,000 will have to be included by virtue of 15 sub 1 when the policy is transferred to a shareholder, while it's included under 6(1)(a) when it's transferred to an employee. For OPCO, the results are slightly different, whether the transfer is done to the benefit of a shareholder versus an employee. Since the non-arm's length transfer rules in 148 sub 7 apply to the transfer, the proceeds of disposition are deemed to be the greatest of those three amounts: the value of the interest, the fair market value of consideration given for the interest, and the adjusted cost basis to the policyholder. In both situations, the proceeds of disposition are deemed to be $150,000. Since the ACB is $50,000 in both cases, the policy gain will be $100,000 in both cases. However, we can see in the last column on the right that when the transfer is done for the benefit of an employee, the employer corporation, OPCO, can deduct a fair market value from its income. No such deduction is possible when the transfer is done to the benefit of a shareholder, thereby resulting in double taxation. Now let's review the situation where consideration is given. We have the same example here before the transfer, shareholder owning OPCO, which owns the life insurance policy, and after the transfer, the shareholder owns both OPCO and the life insurance policy directly. There's two possibilities for the transfer from the operating company to the shareholder. One, the shareholder can pay for the policy, give consideration to OPCO, or in the second case, OPCO can transfer the policy to the shareholder by way of dividend. The characteristics of this life insurance policy are the same as what we looked at before: cash surrender value of $150,000, ACB of $50,000, and a fair market value of $250,000. I want to make a few comments on a life insurance policy's fair market value. CRA has put out information in an information circular, IC 89.3, which generally applies to the valuation of shares in private corporations. However, CRA has indicated that the list of factors used for determining the value of corporate-owned life insurance will also be used to determine the fair market value of any interest in a life insurance policy. The list of factors that would be considered includes the cash surrender value of the policy's loan value, the face value of the policy, the state of health of the insured and their life expectancy, conversion privileges under the policy, the replacement value of the policy, as well as any other terms of the policy that could be relevant. The application of these factors could produce a fair market value, which is materially different than the cash surrender value of the life insurance policy. For instance, if the life insured is expected to die imminently, the fair market value of the interest may approach the total death benefit in the extreme case. Let's come back to our example. In this slide, we're going to look at the consequences that will result when different amounts are paid by the shareholder to acquire the life insurance policy. In the first line of the table, which we see on the screen right now, you see that the deemed proceeds, because again, we're looking at the non-arm's length transfer rules, are the greatest of those three amounts: cash surrender value, ACB, and consideration given. So consideration given is 0. The deemed proceeds are the greatest of those three, or $150,000. When you look at the policy gain that results, the proceeds of $150,000 less ACB of $50,000, you get your $100,000 policy gain. And the new adjusted cost basis for the shareholder will be equal to those deemed proceeds of $150,000. And a taxable benefit results in the full value of the policy fair market value of $250,000. In the second situation, the shareholder gives consideration of $50,000, which is equal to the adjusted cost basis of the policy. It still doesn't change the deemed proceeds. The greatest of those three amounts is still $150,000. Policy gain is still $100,000. New ACB still equal to the deemed proceeds of $150,000, but the taxable benefit has been reduced because of the $50,000 of consideration given. In the third situation, the shareholder gives consideration of $150,000, which is equal to the cash surrender value of the policy. Here we still have deemed proceeds of $150,000. The greatest of those three amounts, actually two of the amounts, are now $150,000, the consideration given and the cash surrender value, still resulting in the $100,000 policy gain and the new ACB for the shareholder of $150,000. Now, of course, the taxable benefit is reduced by $150,000 from the fair market value of the policy, so the income inclusion is only $100,000. And finally, in our fourth situation, the shareholder gives consideration of $250,000, which is equal to the fair market value of the policy. Now the deemed proceeds of the policy are going to be boosted to the higher amount, the highest of those three amounts, and the consideration given in this case will be the highest amount, $250,000. The policy gain is now higher. We have proceeds up to $250,000 compared to the same ACB of $50,000, resulting in a $200,000 policy gain, and a higher ACB for the shareholder. It's now equal to the deemed proceeds of $250,000. And of course, we've eliminated the taxable benefit because the full fair market value is being paid for the policy. As we saw earlier, the application of the rules under 148 sub 7 do not eliminate the potential taxable benefit conferred to the shareholder or the employee as a result of a transfer from a corporation. The difference between fair market value of the policy and the consideration given by the shareholder will still be considered a taxable benefit for the shareholder. And when we're dealing with the shareholder, that's subsection 15 sub 1 as the income inclusion. A second way to perhaps transfer the policy to the shareholder is for OpCo to declare a dividend to the shareholder. It's possible to reduce or eliminate the taxable benefit if the policy is transferred by means of a dividend payable in kind. The amount of the dividend would have to be equal to the fair market value of the policy. However, the declaration of a dividend does not stop the application of subsection 148 sub 7. Since one of the elements to consider in the context of these non-arm's length transfer rules is the fair market value of the consideration given, we should ask ourselves, what is the consideration given by the shareholder when OpCo declares a dividend? This question has been answered by the Tax Court of Canada in a case called Algoa Trust. The court determined that a dividend constitutes a transfer without consideration for the purposes of Section 160 of the Income Tax Act. The CRA has referred to this decision to establish that the same logic applied for purposes of Section 148 sub 7, the non-arm's length transfer rules. Therefore, the shareholder is not considered to having given consideration to OPCO when they receive the dividend in kind. So just like we saw on the previous slide, now we have $250,000 as the amount of the dividend. The deemed proceeds are going to be the highest of the amount of cash surrender value, value of the consideration, which we just determined was nil, and the adjusted cost basis of the policy. So we still have deemed proceeds of $150,000 versus the cost base of $50,000, resulting in the $100,000 policy gain. New ACB for the shareholder equal the deemed proceeds of $150,000. And now, of course, we've eliminated the taxable benefit by paying the policy out as a dividend. Therefore, the consequences for OPCO are the same as in the situations we reviewed on the previous table, 1, 2, and 3. Also, the new ACBs for the shareholder is the same as in those 3 situations, but is lower than in situation 4, where it was the full $250,000 of consideration given for the policy. For a shareholder who is an individual, such as in this case, the amount of the new ACB should be considered mostly in situations where the shareholder plans to access cash surrender value shortly after the transfer. Oh, sorry. The dividend will be taxable for the shareholder at a rate that will depend on the shareholder's other sources of income. However, simply on an indicative basis, the maximum marginal combined tax rate average for all the provinces in Canada for a non-eligible dividend is about 45% in 2020. Now, keep in mind that we're looking at an example with a sole shareholder. In corporations with a sole shareholder, it's relatively easy to have the corporation declare a dividend to the shareholder. In situations where shareholding includes multiple shareholders, it is still possible to transfer a life insurance policy from the corporation to one of those shareholders by means of dividend in kind. However, it would require additional legal documentation to obtain the desired result. A shareholder owns all the outstanding shares of the corporation, holdco in this example, who again in turn owns all the outstanding shares of another corporation, OPCO, which in turn owns the life insurance policy on the life of the shareholder. For business and estate planning reasons, OPCO wishes to transfer the life insurance policy to holdco. The life insurance policy has cash surrender of $150,000, ACB of $50,000, and fair market value of $250,000, just like we saw before. No consideration is being paid for holdco regarding the transfer of the policy. What will be the consequences of such a transfer for OPCO? What will they be for holdco? Would the consequences be any different if the policy was transferred by having OPCO declare a dividend in kind to holdco, or by having OPCO repurchase some of its shares held by holdco? Let's come back to our example. In this slide, we want to look at the consequences that will result when different amounts are paid by the shareholder, holdco, to acquire the life insurance policy. In the first consideration, no consideration is given by holdco. This looks very much like we saw with the individual transfers. We still are dealing with the non-arm's length transfer rules under section 148 sub 7. Deemed proceeds be the highest of the 3 amounts, cash surrender value, ACB, and consideration given, resulting in $150,000 of deemed proceeds. Calculation of policy gain, still the same, $150,000 less the $50,000 ACB, resulting in a policy gain of $100,000. New ACB for the holdco equal to those deemed proceeds of $150,000, and there's a taxable benefit applied under subsection 15 sub 1, $250,000, the full amount of the fair market value of the policy. We're going to go through the same examples here where the consideration was $50,000 or $150,000. Again, the numbers will look very familiar to you because it's the same result as we had with the transfer to an individual. Even when consideration given gets up to $150,000, up to the cash surrender value of the policy, we still have the same deemed proceeds. Policy gain calculated by those proceeds less the ACB, resulting in a policy gain of $150,000. New ACB for holdco being that cash surrender value, and the taxable benefit just being reduced by the amount of the consideration given. And when we go up to the consideration given by holdco up to $250,000, then we have a change. The deemed proceeds are now the highest of those three amounts. In this case, it will be the consideration given of $250,000. This results in a much larger policy gain, higher ACB to the holdco, and of course eliminates the taxable benefit by having paid the full fair market value for the policy. So again, the non-arm's length transfer rules don't eliminate the potential for a taxable benefit. It simply depends on what consideration, if any, is given for the policy. Oh, before I go on to this, I think I should point out a couple of things on these the results. Even if I get to a situation where holdco has effectively has $250,000 in liquidity to give to opco as consideration for the transfer of the policy, it's not a particularly advantageous situation, even though it's the only one with no taxable benefit. It's not interesting because the policy gain is the highest at $200,000, which is taxable at typically 50% or more as the private company investment tax rates. It's also the situation where the new ACB for the holdco is the highest at $250,000, which is important to consider in regards to the capital dividend account for holdco. Since a higher ACB in this particular situation compared to the other ones of $100,000, it means that if the life insured were to pass away immediately following the transfer, the capital dividend account would be $100,000 lower than in other situations. And that means there's $100,000 less in capital dividends available, which could be distributed to the shareholders as a tax-free dividend. So now we're going to look at policy transfers from opco to holdco. And in this table, what we're seeing is the first line shows the situation where the policy is transferred from opco to holdco without consideration. The rules, the non-arm's length transfer rules, 148 sub 7, apply, which means that the deemed proceeds of disposition for opco will be just what we've been seeing in the previous examples. Greatest of consideration given cash surrender value and the policy ACB. In this case, the deemed proceeds are equal to the cash surrender value, $150,000, and the resulting policy gain is $100,000. Since the policy is transferred to one of its shareholders, but the shareholder did not pay for the policy, the taxable benefit results for the holdco. And as we saw earlier, this shareholder benefit is equal to the difference between fair market value and the consideration paid, zero in this case. The taxable benefit for holdco is $250,000, and opco will not be allowed to have any deduction for that amount. In the second situation where we look at the dividend in kind, opco is declaring a dividend to holdco. The value of the dividend will have to be equal to the fair market value of the interest in the policy of $250,000. So OPCO declares that $250,000 dividend for the policy to be transferred that way. The rules in subsection 148 sub 7 also apply in this case, which means the deemed proceeds to OPCO will be the greatest of consideration paid, cash surrender value, in the ACB. The deemed proceeds will be equal to the cash surrender value because, again, with the dividend in kind, the consideration given is deemed to be nil. So this results in the deemed proceeds of $150,000 and the policy gain of $100,000. Since the policy is transferred by means of a dividend in kind, the taxable benefit under section 15 sub 1 is eliminated. The dividend will be treated as an intercompany dividend, which, although initially taxable in nature, should be deductible as an intercorporate dividend under subsection 112 sub 1 and not result in any tax liability. This alternative could be considered for any intercompany transfer from a subsidiary corporation to a parent corporation. And the last alternative, the third line, looks at the situation where OPCO repurchases some of its shares held by OPCO. The value of the shares repurchased will have to be equal to the fair market value of the interest in the policy. Therefore, OPCO would have to repurchase shares which have a value of $250,000 for the policy to be transferred that way. Again, the rules of 148 sub 7 will apply, and CRA has adopted the position that when shares are repurchased, the transferee has given consideration of value equal to the value of the shares repurchased. So in this case, Holdco will be considered to have given consideration worth $250,000, which means that deemed proceeds are that amount because it's the highest of the three amounts of consideration given, cash surrender value, and the adjusted cost basis. This results in a policy gain for the OPCO of $200,000. So a share repurchase leads to consequences similar to a taxable dividend, which means the taxable benefit under subsection 15.1 is eliminated, and the repurchase will be treated as an intercorporate dividend, which should be deductible under subsection 112 sub 1. And tax liability should not result. What you should remember from this table is the mechanics used to transfer a policy from a subsidiary to a holding company should be chosen wisely, as the tax consequences vary greatly between these different options. Here we're looking at a shareholder owning all the shares of Corporation 1 and of Corporation 2. Corporation 1 owns a life insurance policy on the life of the shareholder, and Corporation 1 is about to be sold, so it wants to transfer the life insurance policy to Corporation 2. The life insurance policy is the same as what we'd looked at before: cash surrender value $150,000, ACB of $50,000, and fair market value of $250,000. So Corporation 1 is transferring the ownership of the life insurance policy, and there is going to be a disposition for tax purposes. And the transfer is going to be a non-arm's length transfer because the same shareholder owns both Corporation 1 and Corporation 2. So Corporation 1 is transferring ownership of the policy. Therefore, there's a disposition for tax purposes. Since the transfer, Corporation 1 and Corporation 2, controlled by the same shareholder, they're deemed not to be dealing at arm's length. Since the transfer is between two corporations not dealing at arm's length, we're back to the rules in 148 sub 7, the non-arm's length transfer rules. Therefore, the deemed proceeds of the disposition for Corporation 1 are the greatest of those three amounts: consideration paid, cash surrender value, and policy ACB. In this case, the deemed proceeds will be equal to the cash surrender value of $150,000, and resulting in that policy gain for Corporation 1 of $100,000. The deemed proceeds will also be the ACB of the interest the new ACB of the interest in the policy for Corporation 2. The question of whether a taxable benefit is realized by Corporation 2 is not as clear as in the other transfer situations that we've looked at before. Since Corporation 2 is not a shareholder or an employee of Corporation 1, benefits as shareholder under Section 15 of the Tax Act or employee under Section 6 of the Tax Act would not normally apply to Corporation 2. But is that the end of the issue? Can we conclude automatically that such a transfer does not result in any taxable benefit? The CRA was asked to confirm that no taxable benefit would arise under Section 15 of the Tax Act in a transfer similar to the transfer that we just saw between Corporations 1 and 2. The CRA responded that it is possible that the transferor, Corporation 1, would be impoverished as a result of the aforementioned transaction. In such case, provided that it is demonstrated under the terms of the transaction that the assigning corporation is conferring a benefit on the sole shareholder under Section 15 sub 1, would apply in such a manner as to require the individual shareholder to include the value of the benefit conferred in computing their income. By making this statement, the CRA implies a two-part test in shareholder benefit analysis, that the transferor corporation is impoverished and the sole shareholder is enriched. The CRA has indicated what criteria it would use to determine whether a corporation has been impoverished. Therefore, advisors should be aware of the risk, the possible risk, when structuring transactions this way. The transfer between sister corporations could also be deemed an indirect payment and be subject to tax under subsection 56 sub 2 or section 246. The shareholder could then be assessed a taxable benefit equal to the fair market value of the policy in excess of the consideration paid. So possibilities, but not entirely clear what the tax result will be. Personally owned policies with corporation as an irrevocable beneficiary on death benefit, a portion at one point the corporation allows the beneficiary to be revoked. So what we're trying to do here is transfer rights under the policies without changing the ownership. This type of setup may be done to avoid fair market taxable benefit implications that arise in a shared ownership arrangement where the fair market value exceeds cash surrender value. So the question is, if we set up the policy ownership in this way, has a transfer occurred? The current position by CRA is that a transfer has not occurred, only a change in beneficiary. The insurer does not issue a T5. There is a risk that this position could be challenged. CRA takes the position that the corporation is essentially renting insurance from the policy owner, and therefore all premium payments are taxable income to the owner and non-deductible to the corporation if considered a shareholder benefit. So the next situation we're going to look at is the intergenerational transfers of policies. These are covered under the rules in subsection 148 sub 8 of the Tax Act, which provides an automatic tax-free rollover where an interest in a life insurance policy has been transferred to the policyholder's child for no consideration, and a child of the policyholder or child of the transferee is the life insured under the policy. In order to take advantage of these tax-free rollover rules, it is necessary to comply strictly with the conditions of the provision. The first condition is that the interest in a life insurance policy must be transferred to the policyholder's child for no consideration. The second condition is that a child of the policyholder or a child of the transferee is the person whose life is insured under the policy. However, the transferee child does not have to be the same child as the child whose life is insured. For example, a life insurance policy on the life of the policyholder's child might be transferred under these rules, 148 sub 8, to the policyholder's grandchild. The subsection in question effectively permits a parent or grandparent to transfer on a tax-free basis the life insurance policy purchased by the parent on the life of a child to that child or another of their children. In the case of minors, a transfer may initially be made to a guardian, but not to a trust. The last condition is that the transfer is not made via the parent's will. If these conditions are met, the interest is deemed to have been disposed of by the policyholder for proceeds of disposition equal to the adjusted cost basis of the policyholder of the interest immediately before the transfer. The interest is deemed to have been acquired by the person who acquired the interest in the policy at a cost equal to those proceeds, so the ACB doesn't change. Therefore, the policy gain on a subsequent disposition of the policy would be taxed in the hands of the transferee, provided that transferee is of the age of majority, 18 years or older. So here we're looking at the definition of child. It kind of seems strange that the Tax Act has to define the term child, but they've done so in a couple of different ways in different places. For purposes of 148 sub 8, the term child is defined in subsection 148 sub 9 and indirectly refers to other subsections 252 sub 1 and 70 sub 10. It's a very broad definition of child in this case, which extends to grandchildren, great-grandchildren, and persons under the age of 19 who are wholly dependent and in the custody and control of the taxpayer. That may include the child of a dear friend or nieces and nephews. It can also include stepchildren, step-grandchildren, and spouses of children. There is no time limit as to when the transfer must take place, allowing parents to maintain control of a policy until such time they deem the child capable of taking ownership of that policy. An equally important point is the interest in the life insurance policy doesn't have to be transferred to the child whose life is insured. Again, all these rules covered under 148 sub 8. So the case that we're going to look at here is of Robert, and Robert likes the idea of transferring a life insurance policy to his daughter Emily when he passes away. He likes the idea of allowing the income on his investment to grow in a tax-sheltered environment, thereby building a state foundation for his future generations. He also likes that the transfer is done tax-free and that he can maintain control over the policy until he dies. He wants to know what would the structure of the policy should be. You explain to him that he would be the owner of the policy and his daughter Emily could be the contingent owner. Therefore, he would maintain control over the policy until his death, and he would have access to the cash surrender value if he ever needed the funds in the future. The life insured would be Emily, so the conditions established by the Income Tax Act for the intergenerational transfer are met. The transfer will be done tax-free and will bypass Robert's estate. After Robert's death, Emily will be the owner and the life insured of the policy. As owner, she would then have access to cash values of the policy, and she will be free to name a new beneficiary of whoever she wants. Since you've been Robert's advisor for many years, you know that his family well, and he's just told you he became a grandfather since his daughter Emily just had a son named Steve. Now we want to suggest a different structure of the policy for Robert to meet similar objectives. You explain to him that the previously proposed structure could be modified a little bit. In this other structure, he could still be the owner of the policy, and his daughter Emily would still be the contingent owner. Therefore, he would still maintain control of the policy until his death, and he would have access to the cash surrender value if he needed it. However, here the life insured would be Steve. The conditions of the intergenerational transfer rules under the Tax Act are still met because the life insured is a child of the transferee, Steve being a child of Emily. The transfer will be done tax-free and will still bypass Robert's estate. After Robert's death, Emily will be the owner and the life insured will still be Steve. As the owner, Emily would now have access to the cash values of the policy and she'd be free to name any beneficiary she wants. She could also name Steve as the contingent owner, which would allow for a second intergenerational transfer since the required conditions of the transfer rules would still be met. And this transfer I wanted to look at is for spouses or common law partners. Subsection 148 sub 8.1 applies to transfer during the life of the policyholder's spouse or common law partner, or a former spouse or common law partner in settlement of rights arising out of their marriage. There is no requirement that the life insured be the policyholder's spouse or common law partner in order for subsection 148 sub 8.1 to apply. Both the policyholder and the transferee must be resident in Canada at the time of the transfer. If subsection 148 sub 8.1 applies, the interest is deemed to have been disposed of by the policyholder for proceeds equal to the adjusted cost basis of the interest immediately before the transfer. And it's also deemed to have been acquired by the transferee at costs equal to those proceeds, or still at the ACB of the policy. Subsection 148 sub 8.1 is an automatic rollover provision. However, the policyholder can elect out of the automatic rollover by filing an election in their tax return for the year of the transfer. If the policyholder elects out of the rollover rules under subsection 148 sub 8.1, then we're back to the non-arm's length transfer rules in subsection 148 sub 7. In a technical interpretation, in 2001, the CRA adopted the position that subsection 148 sub 8.1 does not apply to a situation where a life insurance contract owned by one spouse is split in two parts as a result of a marriage or common law partnership breakdown. The CRA does not believe that 148 sub 8.1 applies in the situation where a life insurance contract is split because a transfer of an interest in a life insurance policy cannot be said to have occurred when the result of the transaction is to create a new life insurance policy. Still going on with the spousal or common law partner transfer rules, subsection 148 sub 8.2 applies to a transfer of an interest in a life insurance policy to the policyholder's spouse or common law partner as a consequence of the death of the policyholder. Again, there's no requirement that the life insured be the policyholder's spouse or common law partner in order for subsection 148 sub 8.2 to apply. Here again, the deceased policyholder and the surviving spouse or common law partner must be resident in Canada immediately before the policyholder's death. If the subsection 148 sub 8.1 rules apply, the interest is deemed to have disposed of by the policyholder for proceeds equal to the ACB, is also deemed to be acquired by the transferee at cost equal to those proceeds. It should be noted that for an inter vivus transfer, the deceased personal representative elects out of the rollover rules at 148 8.2, and then we're back to the 148 sub 7 rules to apply. It should be noted that the rollover provisions that we just saw for transfers to spouses or common law partners, either inter vivus or at death, do not apply to the transfer of a policy to a spousal trust. So we started today's session by explaining what a policy disposition is, what the situations are included by the term disposition, and what the consequences of disposing of a policy are. We then looked at different means of accessing the cash value of a life insurance policy. We followed up by different options with different consequences of each of these means and how they can influence the recommendations advisors make to their clients. We then took a look at different forms that policy transfer can take that should be considered by advisors and clients who consider the transfer of a life insurance policy. And then we provided examples of all these concepts and situations based on situations that we often see in our work with advisors. Hopefully, you now have a better idea of what's involved in the transfer of a life insurance policy. Feel free to reach out for help from us at Empire Life with actual cases and technical support for cases you are working on. It's our way of providing added value to you. In turn, you can use to showcase the added value that you provide to your clients. So thank you for having joined us today. That will be the end of our presentation for today. Bye now.